Most people lose money in the stock market, not because the market is a scam, not because investing doesn't work, but because beginners enter the market with wrong expectations, bad habits, and zero rules. Here's a hard truth backed by data. According to multiple brokerage studies and academic research, over 80–90% of retail traders underperform the market over time. Many of them quit within their first 2 years, not because they weren't smart, but because no one taught them the rules. Today, this is not motivation. This is not hype. This is not get-rich-quick nonsense. This is a no BS breakdown of the stock market rules. Every beginner must know if they want to survive, stay profitable, and avoid becoming another statistic. If you follow these rules, you won't get rich overnight, but you will stop doing stupid things that destroy money. Let's begin. Rule number 1. The stock market is not a lottery. The biggest mistake beginners make is treating the stock market like gambling, buying random stocks, chasing tips, following Telegram groups, and hoping something goes to the moon. Real data says otherwise. Historically, the S&P 500 has returned around 9–10% annually over the long term, adjusted for inflation. That return is built over decades, not days. Anyone promising guaranteed quick profits is lying or selling something. Professional investors make money through probability, discipline, and time, not luck. If you think the market is a casino, you'll behave like a gambler, and gamblers always lose eventually. Rule number 2. You are not smarter than the market. The market includes hedge funds, institutional investors, algorithmic trading systems, economists, and analysts with decades of experience and access to massive data. As a beginner, you are not competing with your friends. You are competing with professionals. This doesn't mean you can't win. It means you must be humble. Overconfidence is one of the biggest reasons beginners blow up their accounts. Studies in behavioral finance consistently show that overconfident investors trade more and earn less. Your goal early on is not to be everyone. Your goal is to avoid big mistakes. Rule number 3. Capital preservation comes before profit. If you lose your capital, you are out of the game. This sounds obvious, but beginners ignore it constantly. They risk too much on single trades, refuse to cut losses, and keep doubling down hoping the market comes back. In reality, most successful investors think this way. How do I not lose money first? Warren Buffett's first 2 rules are famous for a reason. Rule number 1, never lose money. Rule number 2, never forget rule number 1. You will have losing trades. Everyone does. The difference is whether those losses are small and controlled or account ending. Rule number 4, never invest money you'll need soon. This rule is non-negotiable. The stock market is volatile in the short term. Even strong markets experience corrections. Historically, the US market sees a 10% correction almost every 1–2 years, and bear markets roughly every decade. If you invest rent money, emergency savings, or money needed within the next year or 2, you will panic during downturns, and panic leads to bad decisions. Only invest money you can leave untouched for years. If you can't emotionally handle seeing your portfolio down 20% temporarily, you're investing money you shouldn't be. Rule number 5. Emotions are your biggest enemy. Fear and greed control beginners more than charts or fundamentals ever will. When markets rise, beginners feel greed and chase prices. When markets fall, they feel fear and sell at the worst possible time. Data from multiple market studies shows that the average retail investor earns significantly less than the market average, largely because of emotional buying and selling. The market transfers money from the impatient to the patient. If you don't have rules to control your emotions, the market will punish you repeatedly. Rule number 6. Timing the market is a losing game. Many beginners think they can buy the bottom and sell the top. Reality check. Even professional fund managers fail at this consistently. According to historical market data, missing just the 10 best trading days over a 20-year period can cut total returns by more than half. And those best days often occur during periods of high volatility, when most people are scared and sitting out. Time in the market beats timing the market. Long-term consistency beats short-term prediction. Rule number 7. Compounding is the real wealth builder. Compounding is not exciting, but it is powerful. A portfolio growing at 10% annually doesn't just double every 10 years. It accelerates over time. The longer your money stays invested, the harder it works for you. For example, investing consistently over 30-40 years has historically turned average incomes into significant wealth. This is not theory, this is supported by decades of market data. The earlier you start, the less you need to invest monthly to reach the same outcome. Compounding rewards patience. Impatience destroys compounding. Rule number 8. Diversification is protection, not weakness. Beginners often believe holding many stocks limits profits. In reality, diversification protects you from being wrong. Most individual stocks underperform the broader market over time. Studies show that a small percentage of stocks generate the majority of market returns. The problem is, you don't know which ones in advance. Diversification reduces risk without eliminating returns. That's why index funds and ETFs are widely recommended for beginners. Concentration can increase gains, but it also increases the chance of permanent loss. Rule number 9. Know what you own. Never invest in something you don't understand. If you can't explain how a company makes money, what risks it faces, and why it has long-term value, you shouldn't own it. Hype stocks, trending sectors, and social media favorites often collapse because people bought stories, not businesses. Real investing is boring, speculation is exciting, and expensive. Rule number 10. Trading and investing are not the same. This rule saves beginners years of confusion. Investing focuses on long-term business value. Trading focuses on short-term price movement. Both require different skills, mindsets, and risk management. Most beginners mix the two and fail at both. Long-term investors don't panic over daily price moves. Traders don't hold losing positions hoping fundamentals will save them. Choose one path first. Master it. Don't confuse strategies. Rule number 11. Risk management is mandatory. Risk is unavoidable. Unmanaged risk is optional. Every position should have a defined risk. Every trade should have a reason to exit, both profit and loss. Professional traders survive because they control losses. Beginners fail because they focus only on gains. If you don't know how much you can lose on a position, you shouldn't enter it. Rule number 12. Losses are part of the game. No one wins all the time. Even legendary investors have losing periods. What separates them is how they respond to losses. Beginners take losses personally. Professionals treat them as data. A small loss is feedback. A large loss is a lesson paid with regret. Accept losses early, or the market will force you to accept them later at a much higher cost. Rule number 13. Information overload is dangerous. More information does not equal better decisions. News headlines, social media opinions, and constant updates create noise, not clarity. Studies show that excessive monitoring increases anxiety and leads to poor timing decisions. You don't need to react to every headline. You need a strategy and discipline. The market rewards focus, not obsession. Rule number 14. Fees and costs matter. This rule is boring and extremely important. High fees, frequent trading, and taxes quietly destroy returns over time. Even a 1-2% difference in annual costs can reduce long-term wealth significantly. This is why low-cost index funds consistently outperform many actively managed funds over long periods. You don't need complex strategies. You need efficient ones. Rule number 15. Consistency beats intensity. You don't need massive investments or perfect timing. Regular, disciplined investing over time has historically outperformed sporadic, emotional decisions. This is supported by decades of retirement and portfolio performance data. Small amounts invested consistently can outperform large sums invested inconsistently. Boring habits create extraordinary results. Rule number 16. There is no perfect strategy. Every strategy has drawdowns. Every investor faces uncertainty. If someone claims they have a strategy that never loses, they are lying. Your goal is not perfection. Your goal is survivability and steady growth. Adapt, learn, and improve, but never abandon discipline for shortcuts. Rule number 17. Education is an investment, not an expense. The stock market punishes ignorance. Learning fundamentals, understanding risk, and studying market history dramatically improve long-term outcomes. Most losses happen not because the market is unfair, but because investors didn't know what they were doing. The market charges tuition either way. You can pay it through education or through losses. Some of the most successful investors are not geniuses. They are patient, consistent, and disciplined. The stock market doesn't care about your hopes, your opinions, or your emotions. It rewards those who respect its rules and destroys those who ignore them. If you're a beginner, your advantage is time, your enemy is impatience. Master the rules first, then worry about profits. If you found this video valuable and want real, no BS stock market education based on facts, not hype, make sure you subscribe to the channel. This channel is about long-term thinking, smart investing, and avoiding costly beginner mistakes that most people never recover from. Hit subscribe, turn on notifications, and stay disciplined, because the market rewards those who are prepared. See you in the next video.